Hello and welcome to our second lecture on relevant information for decision making. So in our previous lecture, we covered learning objective number 1, identifying relevant and irrelevant costs and benefits in a decision. So we said what is crucial is to understand the definition of relevant information in terms of what makes a relevant cost, what makes an irrelevant cost. Now that we are aware of the definitions and their applications in different scenarios, we can now move on to look at how then do we make decisions. So in this video, we will look at learning objective number 2, learning objective number 3, as well as learning objective number 4. All right, let's move on. Okay, so learning objective number 2 is prepare an analysis showing whether a product line or a business segment should be added or dropped. Within this section, our interest is to look at whether we'll be better off closing a division or we'll be better off leaving it open. Here we need to understand how do costs behave, especially with regards to fixed costs, because there are certain fixed costs that won't disappear by closing a division, and it means those fixed costs are going to be reassigned to the remaining business segments if the one we have considered closing has been closed. So with that, you can see that sometimes it's beneficial to close a division, sometimes it's not beneficial. The bottom line is, as long as a division is giving a positive contribution, then that division should be left open. So that's the bottom line you need to carry it through. As long as a division is giving a positive contribution, which is sales minus variable cost, that division should be kept open. All right. So we want to be able to understand how do costs behave within this section as mentioned earlier. So let's look at this company, Lovell Company, which manufactures digital watches. Okay, so because there is a declining popularity of digital watches, this company is now considering discontinuing the product line for digital watches. Okay, so the decision rule is this company should drop this segment of digital watches only if its profit is going to increase. So as long as the profit increases, then the decision is correct. So we want to compare the contribution margin that would be lost to the cost that will be saved or that will be avoided if the product line is going to be dropped. Okay, so let's look at the current scenario. This is the digital watches segment, and we can see that the problem the company has is this segment is making a loss equivalent to 100,000. So then the decision now is to close this division because it's making a loss. So let's then get deep into understanding what costs are there within this segment and how do these costs behave. What will happen if these costs are going, if this division is going to be closed? What will happen to the costs? Okay, so we perform an investigation, then we see that the fixed general factory overhead and the fixed administrative overheads will not be affected by dropping the digital watch division. What does that mean? That means these expenses, these fixed expenses, are now supposed to be reallocated to another division. Or what it means is this decision is not going to avoid this kind of cost. Okay, then we realize that the equipment used to manufacture watches has no resale value or alternative use. So that means that equipment is a sunk cost. We cannot sell it and it doesn't have any other use. Okay, so the question now is, should Lovell retain or drop the digital watch segment? Okay, we are saying if the division is closed, remember the division was making a contribution of 300,000, which is sales less variable cost. So if the division is closed, that contribution is going to go because there's nothing that is going to be sold, and the variable costs associated with selling digital watches is also going to go. Then we now have to look at the fixed costs that this division can avoid. They will be able to avoid the salary of the digital watch line management. So the manager of the division will not be required, therefore we'll save the 90,000. Then we have direct advertising. When this division is closed, we don't need to advertise, so we'll save the 100,000 as well. Then, assuming that we will not undertake any business within the factory that we are renting, that means if we close the division as well, we are going to be able to avoid the rent. So what happens now is we will lose 300,000, we will save 260,000. So what will be your take there? Should we close or should we leave open? All right, we are essentially saying we need to leave the division open, because if we close it, it means our profit is going to further decline instead of increasing. Okay, because we are saying we will lose 300,000 for us to save 260,000. So this is like when it's dark and you drop a $5 coin, you are lighting a $20 note to find a $5 coin. That doesn't make sense. So this is the same situation that we have here. If we close, we'll lose 300,000 contribution and we are able to save our costs to the effect of 260,000. Therefore, we are worse off by 40,000. Okay, we can also do this by a comparative approach, but of course, remember we said we always want to limit the amount of time we spend on a question. This is just for illustration purposes. The best will be to do it by looking at what the contribution you are going to forego and what the costs you are going to save are going to be, then you get the difference. However, alternatively, you can do it in this format where you are now comparing, keeping the division as well as dropping it. So if you keep it, you have your sales, you have your variable cost, therefore you have contribution of 300,000. If you drop, then you won't have anything on that part, therefore the 300,000 is going to be a loss of contribution. Then the general fixed overhead would be the same under both alternatives, therefore that's an irrelevant cost. The salary of the line manager, yes, it's relevant because it can be avoided. The depreciation is a sunk cost. In this case, it will be there under both alternatives, therefore irrelevant. Then when we look at general admin, again, it will be there under both alternatives, therefore irrelevant. So we can now see that when we keep the division, our loss is 100,000. When we drop the division, our loss increases to 140,000. This is because the division is able to contribute 40,000 to the fixed cost of the whole business. Okay, this division is able to contribute 40,000 to the fixed cost of the overall business. So if then this division is closed, then it means the 40,000 now should come from elsewhere within the remaining divisions, which means the loss is now increased from 100,000 to 140,000. So within this analysis, we can then say the division should be kept open. Okay, so you can see this is a similar thing that you got under the previous scenario where we are saying we will be worse off by 40,000. So within the second approach, we are also just saying our loss increases by 40,000, which means our loss becomes 140,000 should we decide to close the division. Okay, so the issue is we need to be aware of the allocated fixed costs. Okay, should we keep the division open while it's making a loss of 100,000? Yes, we need to keep it open because that loss is not only coming from the division, it's also as a result of other fixed costs that are being allocated to the division. So the division doesn't have control of the other costs that are being allocated. So we can't blame the division for underperforming. Okay, so that's it. Then we then need to understand that if we include unavoidable fixed costs, then we are going to make a division look unprofitable, while it's in actual sense, if we just match the costs that are relevant to that division, the division becomes profitable. Okay, so that's it with dropping a division or a segment or a product line. What we then need to do is to look at what is it that we will forego in terms of contribution, what are the costs that we are going to save, then we compare the two scenarios. Or you can do a comparative analysis where you say what will be the implication of keeping, what will be the implication of dropping. Then you assess whether the profitability is going to increase or is going to decrease. All right, so I'll post additional questions on that section so that you can practice on it. Let's then move on to objective 3, which is the second decision that we need to make, applying the concept of relevant cost. Within this decision, our interest is now to look at whether it's beneficial for us to make a product inside or a component inside, or we should buy it from outside. Okay, let's say we have a business and our business is selling burgers. We have seen that we have a greater skill in making burger meat. So that's what distinguishes us from the other players in the market. But for us to have a burger, we also need the brochures. Now, we may decide that we want to make burger meat inside as well as make brochures inside. But then our main business or our main skill is in burger meat. So then making brochures is something we can do, but we may need to assess whether it's beneficial for us to make those brochures inside or we can just go and buy them at SPAR, and then we do what we are specialized to do. Again, to arrive at that decision, we need to perform calculations. Okay, so this happens when a company is involved in more than one activity. Then sometimes the company has to use what it has produced in one division and it has to use it in another division. Or we can take this example of producing burgers and we need to buy brochets kind of setup. So the question will be, should we continue to make the brochets ourselves or should we buy them from outside? Okay, so this you can read on your own just to familiarize yourself with what do we mean by vertical integration. But the summary is simply to say you can be a business and you decide to go forward to the market so that you have a factory and you also have a retail or wholesale outlet, or you can be a business that has a factory and you decide to go back and also own the raw materials. Okay, for example, if you are a shoe manufacturing company, you may establish a business backwards so that you go back and also have a business that processes the leather into a resource that you use in the factory. Or you can think of going forward and you being a shoe manufacturing business, you also have a factory shop or you also have a retail shop or wholesale shop where you sell the product. So that's all about vertical integration. Okay, so the first thing now is we have this company now, Essex company, which manufactures part 4A and they need this part in one of its products. The unit product cost of this part is given here. So we can say the total cost to produce one unit is $30. Okay, then the equipment that we are using to manufacture part 4A has no resale value. The total amount of general factory overheads, which is allocated on the base of direct labor hours, is not going to be affected by this decision. That means, again, that's an irrelevant cost. Then the $30 per unit is based on 20,000 units that are needed in each year. Now, we do have a supplier, an external supplier, who wants to give us the 20,000 parts at a cost of $25. Should we accept this supplier's offer or not? So in essence, should we continue to produce this product, which we are saying it costs us $30, or should we get the offer from the supplier, which looks like it's cheaper? All right, the question here is, we have a unit cost of production of $30 per unit. An external supplier is offering 25. So already this might look like the supplier is cheaper. But this is not always true. We need to perform calculations to see whether the supplier is indeed cheaper or is not cheaper. So do not be caught on the wrong side of things by just looking at the numbers without an analysis. You need to perform calculations so that you can inform your analysis. On the face of it, 30 versus 25 looks like the supplier is cheaper, but let's see what is involved in detail. Okay, so if we then decide that we want to buy outside, Remember, we need 20,000 units, and the supplier is quoting us $25 per unit. So we need to pay the supplier 500,000. Now let's now look at the relevant cost of producing inside. Direct materials, yes, it's relevant. So if we want to produce 20,000 units, we need 180,000. Direct labor, yes, it's relevant. It can be avoided if we decide to buy. Therefore, it's relevant. 5 times 20,000 giving us 100,000. Variable overhead, yes, all variable costs are avoidable because they vary with each unit produced. Therefore, if we decide not to produce, this cost is avoidable. So in the make decision, it is relevant, 20,000. Then we go to depreciation of equipment. The equipment was already bought, so it is a sunk cost. And the fact that it doesn't have any resale value, that means there is no opportunity cost there. So the relevant cost of the equipment is 0. Supervisor salary, yes, that is avoidable, because if we then decide we want to buy from outside and we are not making any more, it means we no longer need a supervisor. So that is relevant. Then general factory overheads. These overheads are allocated overheads, which means whether we make, those overheads will be incurred, or we buy, those overheads will be incurred. Since they don't differ between the alternatives, then those overheads are irrelevant. So if we then now dwell into the relevant cost of making, we can see that it actually cost us 340,000 to make inside, whilst buying from the supplier is going to cost us 500,000. So what is the best decision here? Definitely the best decision is for us to continue making from inside. So you can see that the decision that we have made, on the face of it, our cost of production is 30, but the 30 includes depreciation, which cannot be changed. It also includes factory overheads, which cannot be changed. So if we then just use costs that are irrelevant, we end up making a wrong decision and advising the company to purchase from outside because it looks cheaper, while it's in actual sense, it's actually cheaper to continue making from within. So this is how we apply the make or buy decision. Okay, I've already explained why these costs are relevant and irrelevant. Okay, so the next thing we need to look at now is a special order. So before that, we now need to understand another concept of opportunity cost. We have already applied the concept of sunk cost. As you can see, we are talking about machines that were already bought that do not have resale value, as machines that are having a sunk cost, which is irrelevant for decision making. So let's now look at opportunity cost. Opportunity cost is the benefit that is forgone as a result of pursuing some course of action. Okay, so when we look at opportunity cost, we are saying these are not actual cash flows or actual cash outlays. And when we are doing formal accounting, we don't record opportunity costs, but for decision making, it's very relevant to include the opportunity cost. Okay, we can give an example to say, when you decided to sit for this course, there was also another thing you could have done with the same time. perhaps you could have watched a movie. Okay, so we are now saying, because we have those two alternatives, doing one of it has got an opportunity cost. Okay, if you decide to sit down and view these videos and listen to the lecture, then it means you're going to forego the benefit of enjoying the movie. If you decide to enjoy the movie, you're going to also forego the benefit of passing the course. So in everything you do, there is opportunity cost. So for decision making, we then need to ensure that we include the concept of opportunity cost. All right, so let's now look at learning objective number 4. And within this, we want to do an analysis showing whether a special order should be accepted or rejected. When we talk about a special order, we are referring to an order that comes to a business, but this order is not something that happens every day. This is something that just comes just once off. And we want to assess whether it should be accepted or it should not be accepted. Here again, you need to apply the concept of relevant cost, because if you don't apply that concept, you may end up rejecting something which is beneficial, or you may end up accepting something which is detrimental. Okay, so we have looked at what a special order is. Then we're now saying, when analyzing a special order, we need to deal with incremental costs and benefits. Okay, the existing fixed manufacturing overheads are not affected by the special order, therefore they are not relevant. So here we want to use an incremental approach. By how much will our revenue increase? By how much will our costs increase? Then we look at the increase in revenue versus the increase in costs and see whether we are going to be better off or we are going to be worse off. Okay, so let's look at Jet Incorporated, which makes a single product, and the normal selling price is $20 per unit. There is a foreign distributor that is offered to buy 3,000 units for $10 per unit. So you can see now, this is the problem. Our normal selling price here is $20, and this customer is demanding half the price. On the face of it, this looks like it's unreasonable, because how can a business which is selling at $20 accept something that is now half the price? But the story doesn't end there. We now need to understand whether this Jet Incorporated can still be able to manufacture the 3,000 units within their capacity, which they are not using. If they can manufacture 3,000 units within their capacity without taking away some products from their current customers, then this might be worthwhile, but let's see what is involved. Okay, so we are saying this is a one-time order that would not affect the company's regular business. So it's a one-time order, once off. Annual capacity is 10,000. The company is only producing and selling only 5,000. So you can see that the company is able to accommodate the 3,000 units without affecting their normal business, which means the company is actually underutilized currently. So is it better for them to go for this 3,000 units, which are going to be sold at half the price, or it's not better? We then need to look at what are the relevant costs of manufacturing the 3,000 units. Okay, so the normal business, looks as we have here. The selling price is $20 per unit, and remember our capacity is currently 5,000. Therefore, the total revenue that we get is 100,000. Then notice that the variable costs also vary with the units produced. So if we want the per unit variable cost in this question, we just divide by the number of units produced. So we can see that we have fixed manufacturing overheads, 28,000. We have marketing costs that are also fixed, 20,000. So total fixed costs in this scenario is 48,000. We are now saying, since these costs are fixed, whether we have a special order, the fixed cost will be 48,000. If we don't have a special order, the fixed cost will still be 48,000. So these fixed costs do not differ between alternatives, therefore they are irrelevant. Okay. Now let's then move on. Remember, we said we just take the total variable costs divided by the total units. Then we can get the variable cost per unit. If you want, you can divide 20 divided by 5,000, you get an answer. 5,000 labor divided by 5,000 units, you get an answer. You add them together, you come to the $8 per unit variable cost that has been given. Okay, so let's now look at what happens now. If they are going to accept the special order, they will increase their sales revenue by 30,000 because they are going to sell additional 3,000 units at $10. Mind you, $10 is half the price, but we are saying since this company is only able to sell 5,000, if then they reject the 3,000, it means we are comparing $10 with 0, not $10 with 20. It's $10 with 0 because either they agree to the 3,000 units and get $10, or they don't agree and get nothing and only sell the 5,000 that they normally sell. Then we have calculated that they are making a product at $8 per unit. Therefore, that means their variable cost as a result of accepting this order is going to be 24,000. Therefore, there is a net increase in income of 6,000. Should they accept the order or should they not? Definitely, they need to accept. An alternative way was to look at how much the product is being sold. That's $8. $10. How much is the cost of producing? $8. So then we're now saying the product is making a contribution of $2 per unit times the 3,000 units that we need to sell out. It means we will increase our contribution by 6,000. As long as contribution is positive, then the decision should go ahead because it is beneficial to the business. Okay, so of course we have assumed that fixed costs are unavoidable and variable marketing costs must be incurred on the special order. However, in a question we need to read carefully. Sometimes marketing costs may not be needed in a special order because the special order is already having a customer. We may not need to market it. Okay, let's now look at a quick check. We have Northern Optical that sells Excellence for $50. The variable production cost is $10. The fixed cost is $18, and the variable selling is $1. A customer has requested a special order for 10,000 units of excellence to be printed with the customer's logo. The special order would not involve any selling cost. Remember what I said in the previous slide. But Northern Optical would have to purchase an imprinting machine for 50,000. Okay, now this imprinting machine is a fixed cost. However, notice that this is an avoidable fixed cost, because if they decide not to accept the special order, they can avoid that 50,000. The 50,000 is needed by the customer to have a logo printed on the X lens. So that's a fixed cost, but that's a fixed cost that is avoidable. And because it is avoidable, it becomes a relevant cost. Like I said previously, be careful, certain texts may tell you that fixed costs are always irrelevant, which is not true. If fixed costs are avoidable or they vary between the alternatives, then those fixed costs are going to be relevant. Okay, let's see the next page. So the next page is now asking what is the rock bottom price, or what is the minimum price which Northern Optical should not go beyond when they are negotiating with the customer. In other words, what price would Northern Optical actually be losing money? What price below which they will be losing money on this sale? Assume there is ample capacity to fulfill the order and the imprinting machine has no further use after this order. So what we now need to do is to look at what are the relevant costs. Okay, what are the relevant costs of this order? Then from the total relevant cost of this order, we then divide by the 10,000 units that are needed, and in the end, we can come up with a cost per unit, which is the minimum. The minimum means we cannot go below. Okay, so can you work it out? All right, I assume you worked it out and you got 15. What we've done is we have looked at the variable production cost for 10,000 units. Okay, it's coming from, we said the variable production is $10 per unit and the customer needs 10,000 units. Therefore, it's 100,000. Then we also have fixed costs, fixed production cost of $18 per unit. But these costs are fixed costs, therefore they do not change between alternatives. Remember, fixed costs do not vary with the units. So these additional units of 10,000 are still going to be on the same fixed costs that are affecting the current production. Therefore, for this decision, they are irrelevant. However, the imprinting machine is relevant because it's avoidable. If we decide not to go for this order, we are able to avoid that cost. Therefore, the total relevant cost will be 150,000 and the number of units we are going to produce is 10,000. Therefore, the average cost per unit is 15. So this is the minimum price we need to accept. If the customer offers 16, then we are better off. If the customer offers 17, much better. If the customer offers 14, reject outrightly. If the customer offers 15, that's like break even. We are not making a profit. We are not making a loss. So we can then put other considerations. Okay, perhaps this is a customer that is based overseas, whom if we sell to, we may also be able to show the presence of our products in overseas markets, which has the potential to generate future sales. in that scenario, we may also just accept a price of 15. But there are a lot of considerations that you may need to put into your analysis. However, the bottom line, if we are looking at from it at a financial side of things, any price above 15, accept. Any price below 15, reject. Okay, so basically that's how these three decisions are supposed to be performed. We looked at dropping a product or a business segment or a branch. The concept there is you need to assess whether the overall business which is going to remain is going to be better off or is going to be worse off. If better off, then the decision to close is correct. If worse off, then the decision is incorrect. Then make or buy decisions, you need to consider relevant costs so that you can arrive at the correct decision. In our example, to make it was $30, to buy it was $25, but within the making of $30, there were costs that are not relevant. So on the face of it, it appears like to buy is cheaper, but when you do an analysis, you then discover that no, it's not beneficial to make on your own. Then lastly, we've done special orders, and we have said, again, we need to assess using relevant costs to see whether our profit is going to increase or decrease as a result of the special order. All right, so I will upload questions on Moodle where we can reinforce what we have learned. All right.